is it tax wise to pass on single family home properties before my death to my kids? We have plenty of income, and passing on a few of them to our 2 kids might even lower our tax bracket. Each rental property is in a separate LLC, and we have owned them for 7 to 8 years now. What do you say?
Based on the way we answered the previous question about gifting, I think it's a bad idea, especially if you had it 7 or 8 years, so that's probably appreciated considerably. I would not gift these properties to my children.
Right. Remember the rule.
Yeah.
I just want to, these guys need to remember the rule. If I gift Jeff a property, he gets my basis. If I have appreciated property and I die, it steps up and Jeff never pays tax on all that gain. If I gift it to Jeff during my lifetime, he's now got this lower basis and all this becomes taxable. It wouldn't have been taxable. So go ahead.
So I'm going to propose something and see what you think, Toby. We talk about property managers a lot. There's nothing that says that your children cannot be your property managers, or that you can't slide income to them from your to lower your taxes.
Yeah. You could set up a management, a family LLC tax as a corp. They could sit on it. You could reimburse them for things like medical, dental, vision, cell phone, any tech that they need that benefits the business. Teach them how to do your business, and you could move money to eliminate some of that tax, get it over to your kids' tax brackets, or in that case, it'd be 0, so they wouldn't even have to pay tax on it.
One other thing I would suggest, is because it's come up a couple times, is if you got all these properties and they're all making money, you may want to consider cost segregation on one of the properties, maybe. And you could do that over the next however many
to eliminate
properties,
the tax, because
to eliminate the tax.
You accelerate the depreciation. So depreciation's generally on a single family home 27.5 years, and you could break it into 5, 7, 15-year property, and the 27.5, about a third of that property would be accelerated realistically under this scenario, probably into, I mean, the 5 and 7-year property would be immediately deductible, any amount that you haven't written off.
Yep.
The 15-year property would be accelerated, a big chunk of that. Like, you wouldn't even have to bonus depreciate it. You just have a massive loss in the year that you did it. I'm going to throw one other thing out, just because I always like the charitable stuff. You want to get a nice tax deduction, set up a family foundation or family charity. And believe it or not, depending on the type of property this is, that could actually qualify as a charitable activity. If it's Section 8, or if it's housing for veterans, housing for single moms, housing for residential assisted living. There's a whole bunch of categories, or just Section 8, affordable housing. That's a charitable activity. You can set up a 501c3, and if you contribute one of these houses, it is 100% deductible against your adjusted gross income. There's a limit of 30% of your adjusted gross income that can be written off in any given year from donating appreciable assets, but you can carry that forward 5 more years. So if I look at this and I say, hey, we have several rental properties, give it to your charity. Your kids run the charity. They're entitled to salaries and fringe benefits out of that. Again, think all of their tech, all of their stuff, reimbursements for medical and things like that. But it's out of your state. Your kids can't screw it up. If they have a broken picker and they're bad at spouses, right? They can't lose it in a divorce. If anything happens to you, it doesn't have to get probated, but you get a nice big fat deduction, and your kids get the joy of running a property that has social benefit, and you get this big write-off. And kids get to continue to operate that thing.
So wait a minute. I bought this house for $150,000. It's now worth $350,000.
Huh?
What's my deduction?
$350,000. I just lived that this year. I did that exact scenario. I bought it for $90,000, and I think we did. What did our Florida property, Patty, the one that we gave away? What was the fair market value? Let's see if she actually pops it in. She's listening. $330,000. Boom.
Wow.
Yeah. Toby needed a tax deduction, and it was actually good. It was I've told this story. It's not to pat myself on the back, right? But it was a gal that she got booted out of her house because her kids used it as collateral on some dubious business dealings, and she lost a house, and she's blind, legally blind, and she'd lived in the house for 30 years. They used it as collateral. She loses it. It's a guy I know. So I went to the bank and I bought it back and said, Mom can stay there. And I said, like, kid was good. I know them. I'm not going to get into all the specifics, but it was one of those things where I was like, I'm never going to get paid for this thing. I'm never going to be able to buy it back. So Mom can stay in it. So I gave it to one of my charities that does assistance for other people that are in need. And I was like, hey, you can just live there for the rest of your life. You're older. I don't know how long, but you live there until you can no longer live there. I'm not charging rent or anything like that. So it's like, cool, this works great. I get a big deduction. I held it for a few years before I did that. So I get the nice tax deduction. Yay. Pretty much the deduction paid for the property. So that's why the government does it for you. So you can do that too. So I just want to sell it. And add-on question, if the kids want to sell it in the charitable institution in the future, what happens then? It is tax-free, it's exempt, but the money is in the charitable institution and would have to come out either as payment for their services, so they could get salaries. They could, if it no longer does its charitable activity, it's probably going to become a private foundation, which means it would need to give away 5% of its assets every year, and they could charge a wage until the money's gone. That's not uncommon.
A common misconception that we frequently run across is the nonprofit that I own. Time out. You don't own this nonprofit anymore.
You control it.
You control it.
That's it. But anyway, so you have options. You have options.
If you're going to make the charitable contribution, it has to be done by December 31st.
And give the LLC.
Yeah. Yes, absolutely.
Each property is in a separate LLC. You get an appraisal done. And what's the form you're going to file with your 1040?
Help me out here, guys.
What's the
8283?
8283. You're going to file the tax form that says, with the appraisal, the appraiser signs the tax form, I should say, saying here's the appraised values. And then if it's over $5,000, it needs that appraisal. But you get that appraisal done next year if you really wanted to.
Yes.
Like before you file your tax return. And then it just has to accompany, and I'll see if anybody puts that up. All right. This should be the last questions. It's the 8283. You're very intelligent, sir. That's good. You plucked that out. Hey guys, if you like this snippet of Tax Tuesday, then I invite you to click the link and actually subscribe to become a Tax Tuesday member. Every other week, we do these live, and you too can ask your questions, and myself and my team will answer your questions on the next Tax Tuesday.